Hello, everyone. My name is Sidharrth Shankar, and I'm one of the partners at JSA. Along with me, I have my colleague and partner, Vikram Raghani. He's also the co-chair of the corporate practice. We have with us our guest, Mrinal Chandran, General Counsel, India Resurgence Fund. In this discussion, we aim to delve into key factors considered by private equity funds on corporate governance. So, Mrinal, welcome to this conversation. And firstly, let me congratulate you on the two concluded deals in the hospital and in the pharma space. So, just moving on, now companies which are well governed and managed with certain governance premium, ECG has become an important and prominent in the investment ecosystem today. What are the areas of governance which you focus on before committing capital? And how do you look at governance from an exit perspective?
Siddharth and Vikram, thank you for having me. It's a pleasure to be part of this conversation with the two of you. Obviously, the alternative space is evolving. And I've been in this space for the last decade and a half, and I've seen that evolution. And with that evolution, obviously, a lot of things have changed in terms of how funds, and they could be, obviously, all funds are not sort of the same types. So, like, there's venture capital, there's private equity, there's buyout, there's credit, there's real estate. There's REITs and InvITs that are coming in as well. So, multiple asset classes that have sort of come in, and each of those will bring in their own nuance and own style of governance to their portfolio companies. So, I think it is, as India increasingly becomes a prominent spot in the alternatives space globally. We're seeing more and more, even before we think about our portfolio companies, we're seeing investors come and ask us questions, right? So potential LPs will do an operational diligence and of the GP itself, the India manager or the fund manager, and see what they have in terms of governance and practices there, right? So we all have detailed operational questionnaires that we get from potential LPs, large ones, in terms of how we implement governance. And they're concerned, what are the things they're concerned about? They're concerned about, so it's not just about the entry and the exit and the multiple and the opportunity. It's about, risk, reputation, how do you monitor, how do you govern these companies, what kind of internal controls, internal audits, what are the systems that you set in place in these companies? And these are, as you rightly said in your question, these are all value accretive. These are not check the box compliance anymore. They're all value accretive. So, for example, if you have a process in terms of governance, so it's not just about compliance anymore. It is, if you have a process where for example, in a buyout, where let's say India RF were to go and buy a majority stake in a company, how quickly can you build a governance structure where escalations happen properly? Decisions on key matters are taken promptly, right? And there's no opportunity for stuff to slip between the cracks. The difference between buyout funds and sort of promoter-run companies is that the promoter is always there. It's always there. So the buyout funds, people will be sitting in Mumbai but running a company somewhere in the north of India or in the south of India. So if we are able to build these good teams, strong teams, and good governance structures, it shows that the company can run in some ways without its owner, which is a premium. Okay, so there's a premium that when we exit as investors, there's a premium that a buyer is going to attribute to that what we build, right? And we should also remember that while the system is evolving, the system is also now got more sources of exit. So it's not just the Indian strategic that is looking to buy assets from private equity investors. I'm just going to take the example, for example, of roads or renewables, infrastructure, utilities, those kind of things. You can see strategics trying to buy those assets. You can see pension funds. You can see sovereign wealth funds, platforms that are being run by private equity investors or private equity investors themselves, right? So all of these, a huge bucket of those investors are actually looking for good or willing to pay premium for well-run companies. And so governance has increasingly become a key milestone and a differentiator for sort of the top end funds. The funds that are really doing well, are able to raise global money, will have good governance structures for their portfolio companies and for themselves.
Yeah, that's interesting, Mrinal. I think you sort of laid the pathway for uh, for a discussion on this. And I think there are 4 or 5 key areas which everyone is focused on, right, when it comes to governance. One is obviously ethical conduct and integrity, right? Investors are looking at management and how they've conducted their businesses in the past, and second is obviously conflict of interest, right? In many cases, you have transactions between the companies and the management or the promoters, and how has the company or how have the promoters managed that conflict. Third area I would say is board composition and independence. I think increasingly investors are looking at diversity in the board composition, right? Whether it comes to gender diversity or whether it comes to independent directors, and we'll come in a bit to how regulators are looking at it. And then lastly is obviously ESG practices itself. And like you rightly mentioned, this is no longer a tick the box exercise. I think we've seen uh, on deals where enormous amount of time is spent on actual ESG compliances. Investors have ESG committees. They require portfolios to form ESG committees once they come in, and so on and so forth. So I think these are 4 or 5 key areas. And we must necessarily mention that regulators are increasingly sharpening their focus on governance aspects, right? So let's take the example of SEBI. Now, if you see in the last couple of years, SEBI has brought in a whole lot of amendments as far as listed companies is concerned, purely focused on governance aspects. So maybe quickly touch upon a few and then get your thoughts on how those lend into your thinking when you're looking at investments in listed companies, especially when you're looking at control. So I think the first and the most recent amendment was when SEBI has now said that any agreement, which is basically a shareholders agreement, which gives special rights to any shareholder in a listed company, must be put before the shareholders for approval every 5 years. Now, this is a huge change, and it obviously it's a great change from a governance standpoint, in that the general principle is that in a listed company, all shareholders must be treated equally. But then when you have a controlling shareholder, when you have a promoter who seeks certain special rights, those are now made subject to checks and balances by the public shareholders. So, whether it's reserved matters, tag along, transfer restrictions, any kind of board seats, majority on the board, etc. All of these are quite important for a buyout investor, but these are now subject to approval by shareholders, and that to every 5 years. So it lends a little bit of uncertainty in terms of, if you look at a fund who typically likes to hold an investment for over, say, 6-7 years, what would happen to those rights over a 5-year period? So that's one area. I think the second area is related party transactions, right? So related party transactions have always been subject to majority or minority approval. That's been the law for a while now. But what has been done recently is that the scope of a related party transaction has been increased enormously. So, for example, earlier promoters were related parties. Now, anyone who holds more than 10% is considered to be a related party. That's quite a stringent, sort of strict threshold to define related parties. And then any transaction which is intended to benefit a related party is also called a related party transaction, therefore subject to a stricter approval requirement. Similarly, permanent directors, right? SEBI's now said that no one can be a permanent director unless approved by shareholders, after every 5-year period. So I think some of these requirements are obviously very good from a governance standpoint. And as listed companies get more and more institutional money, and the markets are where they are going, these are important amendments. But as an investor, I'm sure you have, these sort of lend into your view or your thought process when it comes to investing or doing a buyout deal in a listed company. So any thoughts on how these mold your decision making in these kind of situations?
I mean, it's interesting you bring these kind of things up. So one of the things that we've had for some time is upside shares. So when you did pre-IPO investments, and you were hit the nail on the head, so to speak, and had an IPO in one of your portfolio companies, the upside share arrangements had to be disclosed to shareholders and had needed an approval, right? Even so, the first shareholder meeting after the IPO, you had to go and get approvals. And we've always seen that and thought it makes sense, right? Because if you have an arrangement where the promoter is getting paid out from you, let the shareholders know. So it started off as disclosure and became an approval requirement and those kind of things. And to your point on related party transactions, the thresholds going down, it's a good sign in some ways that markets are evolving. The Indian market is evolving, and companies are becoming bigger, where the people who will control these companies need not necessarily be 50% plus. So there could be much smaller shareholder groups inside some time, or there could be professionally run companies with professional management with a significant shareholder base, right? One significant or few significant shareholders who might have call the shots, right? So I think I think in some ways legislation is sort of preempting what might be coming in the future, which is much bigger listed companies, and some of these issues around governance where preferential sort of transactions are not happening. So I think to me it sort of bodes well for the future, that there is visibility to a future where companies will have a 10% shareholder could be considered significant, right? From the India RF perspective, I think we look at a horizon of 4 or 5 years to try and exit our investments, right? So we've not done a listed company buyout. We've looked at doing this in the past, but we've not really done a listed company buyout. But I think we understand the rationale behind this, which is that I think the regulator in some ways is saying that, listen, you have 5 years, you can have a set of rights that are there. And at the end of 5 years, there has to be a sunset to your preferential status as a shareholder. And post that, listen, either you get shareholders to approve this again or live like any other shareholder. So there is a logic to it. I think private equity investors, generally speaking, should be fine with something like this, which is they're given enough of a time where they've built special rights for themselves for things they may need, for example, the ability to sort of raise debt, or change the capital structure, go and do private, like buyouts, etc. But at the end of that period, you're just one among the other shareholders. You exercise your rights through your block of shares, right? So I'm not sure how industry or other people feel about it, but I think India RF would be sort of with something like that and understands the rationale behind it.
So very interesting, Mrinal. Thanks. I think what Vikram and you bring up is important aspects. And as we get into the whole, and before you invest into the company, and governance being one of the important things, as lawyers, we of course look into some of these aspects in a diligence point of view. We also look into various other aspects to make sure that the company is good from a governance standpoint. But from an investor point of view, and purely from your experience of doing over 2 decades of investment, and your experience, what do you look at as a governance point when you give advisors the mandate to run the diligence? What would be your expectation? How do you look at that?
You mean in terms of the existing governance of the company?
Yes. So if you're looking at a potential company and you're looking at an investment, what would be the instructions that you would look at in providing to your advisors to see how you would want to cover? So we've seen that in some of those aspects of how different investors look at it differently on many of the deals and how deep they want to go into some of those aspects. So it'll be interesting to see, how do you look at, as knowing IRF being quite stringent in how the diligence aspects are looked at by them?
Yeah, so I think in some ways we see ourselves as active investors. I will not use the word control investors, but active investors, which is we get into special situations, turnaround kind of stuff. So governance for us is very important. And I think it starts with sort of good compliance and stuff like that. So we obviously invest in companies that may not be at the peak of their health when we're investing, right? So I think for us, one is to assess past compliance and sort of past issues that may have happened before we came in for various reasons that may have been beyond the control of people. And then as we establish ourselves in that company, what would the exact governance structure be? So it could range from statutory compliances, approvals, internal controls, internal audit, having a cadence of internal audit, and having an internal audit of a company that is, in a short span, actually 360 of the enterprise goes through an internal audit. So that could include every function within the organization, and we do that, say, every 2 years, right? So every 2 years, the whole organization gets checked. So you can keep finding the gaps and keep plugging them, right? And like I said when I spoke earlier on this, is that obviously building an enterprise where decision making is quick, decision making is effective, and it takes care of the needs of not just the enterprise, but also the needs of the investor and other stakeholders, other capital in that company, shareholders, etc., employees, etc. Right. So I think building responsible governance structures to stakeholders has been at the heart of what we do as India RF. And we've done some other stuff along the way. So we, because of the nature of our mandate, I think we also do monitor our assets pretty closely. So we have a monitoring system and a team that will go and spend time with the asset and make sure that the stuff that we want done is actually getting done, right? So we've built not just monitoring, we've also built an operational team. So India RF also has an operating partner and an operating team that will go and sort of do the cadence and the turnaround and the implementation of the strategy and so on. So again, this is part of the whole active investment strategy that we have. Different other strategies may not have as much of an involvement in their companies as we. But we tend to be more involved in our companies just in terms of knowing what's happening, knowing their health, and sort of contributing to them positively by sort of enhancing governance structures. I think the other point that you brought up, I think Vikram brought that up, is ESG. So ESG is becoming very, very important. It is sort of becoming central to the investment agenda. It's no longer just a compliance item. You're seeing SEBI making disclosures and disclosures for public market investors to see where ESG is going in these companies. We're increasingly seeing the adoption by all classes of investors. So not just the multilaterals or the sovereigns, but other classes of investors who are coming in and saying, listen, we want a certain standard of ESG. We want a following framework of ESG. To be adopted by you as a fund manager in the context of your investments. So it is becoming very central to the whole investment agenda that you have. I think just 2 days ago we were having a discussion with someone. Emission of greenhouse gases, a monitoring system for emission of greenhouse gases. So it is going to become a huge theme, and I think, like everything else, there will be a structure and a governance mechanism, and different types of professionals will get involved in it, and at different types of societies. I see lawyers getting involved. I see people contributing strategy. I see people contributing monitoring. I see operating teams going in there and implementing stuff. So it is going to become one of the more important themes in the next decade. And I think India has a huge role to play, because I think in some ways we're a little behind in terms of catching up with ESG, but you will see that things will move very quickly here, because global capital is needed, and global capital is coming in at a very significant pace. And so with that, I think that will be the catalyst for a lot of these practices getting adopted.
I think with requirements like BRSR and ESG ratings and the constant need to sort of make those public, I think very soon quality money will be attracted only by companies which are following these norms and standards. So that's absolutely going to be very, very pertinent going forward in the future. Yeah.
Completely agree with you. So Mrinal, just bringing one of the topics and one of the points you raise is the building responsible governance structure. Look into it every 2 years. Can you just explain what are you saying in that, in the sense of the 2-year period? So you re-look into your portfolio and see that everything is going fine, because this is fascinating in many ways to re-look at it and not just invest and leave it.
Right. So I'll give you an example. So we for example, if we were in a portfolio company, okay, so one of our portfolio companies is in this F&B space. And in the F&B space, you would think that, so there's licenses, but there's also IT, right? And so we will go and say, hey, listen, we want to do a study of how strong our IT frameworks are, security, et cetera, right? So this may not be core to the business, but it's a great value add, right? So we would do that IT cycle. So it could be IT, it could be finance, it could be compliance. So we pick up different parts of the enterprise, okay, and take it through a process where it is stress tested for how good or how strong is that governance structure. It could be business continuity as an example. So things go wrong, servers crash. How does the business continue for a while, right? So all these areas get evaluated. And so if you did that, let's say in 2023 in September, okay, and you forget about it, and that's not responsible governance for us. We will do that again in 2025 and see that and so, a typical exercise like this will throw up gaps, will throw up things that you need to enhance. The process then is to try and enhance that in a given time frame. Okay. And then go back maybe a year, 2 years, or depending on the size of the enterprise. And so bigger enterprises tend to be more mature, frankly, and will be able to adapt faster. And smaller enterprises tend to not have, as robust systems as they are to sort of rapidly evolve in some ways, right? So, a small enterprise, we might do this every 1 year, which is annually go back and check and see what we need to improve again. Then we go back again a year later, see what we need to improve again, right? In a bigger enterprise, it's every 2 years that we will go through this cycle. So the process is continuous improvement. Okay, the process is you sort of check for controls and you build governance depending on the scale and the size of the enterprise. So given that we provide capital and we're trying to get our companies to grow, we see that these enterprises change very quickly in the short span of time because, a lot of the bottlenecks they have faced, and the largest is in some ways capital, is made available to them. So they are now don't have the worry around capital. They can just go and implement their business plans, right? And so that process of growth, sometimes growth can, not necessarily be fully checked and fully planned, but we're there to make sure that that process is done sort of meaningfully. And then every once in a while, someone comes in from the outside, or there's a third party or someone even from an internal system who comes and says, okay, these are the things we could potentially also improve on.
Lovely.
That is a great value add for our portfolio companies.
Lovely. Now, before we end, last question. How do you unwind?
How do I unwind? Well, I'm fond of a few things. I read quite a bit. One of the hobbies that I've had as a child, and I've sort of taken it up again, is astronomy. So I have a giant telescope that's a little too big for my house, but it's a great way to unwind because what it does, it forces you to get out of the city. The city is too bright for astronomy, so you end up having to take your telescope and drive outside the city for a couple of hours. So it does two things. One, it gets you out of the city, and then it gets you a good night and good night of stargazing and seeing some very interesting stuff. So I've had some very interesting stuff that I've seen outside Bombay. So I've seen meteor showers, I've seen comets, I've seen the edge of the Milky Way, I've seen Saturn with its rings.
Really?
Lots of very, very interesting things. So yeah, this has been one of my very interesting things that I picked up actually through COVID. Picked up again. So I had a telescope as a child, and I picked it up again through COVID. But it's been fun.
Fascinating.
That I've taken up.
This part of your fascination, knowing you for 23 years, is something I got to know today. So good to know that. But Mrinal, thank you very much. I know you're a busy man, and thanks, Vikram. With this, I think it's been a lovely interaction, dynamic issue driven by regulatory changes and stakeholder concerns. So I think we should do more of these because not only it helps all of us, but even the viewers who's going to listen to this. But Mrinal, what a session, and thank you so much.
Thanks, Mrinal. Absolutely. Great listening to you.
Thank you, Vikram, and thanks to Chambers.
Bye. Bye.